What a way to end the week. Let's just get into it. So we're going to start with oil and then we'll continue onwards. Oil finally broke and held below that $62 to $64 range that we were focusing in on. That no longer holds water for the time being. As you can see, this zone over here has finally broken on the downside. We originally thought that on Friday, this $60 was going to hold. We actually thought maybe you'd see a little bit of a peak and then kind of hold and chop around. Clearly, we broke through it. However you want to say it was a tweet, whatever you want to use as an excuse for why it happened. Bottom line is it's happened. So we got to get over it and move on. So the question is, where do we go from here? So our original target zone was 55 to 60. This is our target zone. We think the market's going to chop around in here. This is a daily, so when you see the daily, it doesn't look like it's too much going on over there. But when you go take a little bit of a bigger picture angle of it, and you, let's say, go to a monthly, and you go back to that zone, you can see it a little bit more pronounced. That $55 to $60 zone is about here. We think that's going to be your new point of reference. We think the market's going to chop around over here. It does tie into where the market has been. So when we extend these lines a little bit, we're not very big on the whole line business, but we feel that certain times they're important. So we want to just point it out. This is that zone where the market was pretty much living for quite some time. You see the market just hangs out this $55 to $60 zone, gets above it, but it's constantly coming back. So this is to a large extent your mean. So any reversions, you're just following the same pattern. Yeah, we popped out of it. Now we're coming back into that $55 to $60 zone. We think the market lives here for the time being. Maybe the market will get out and get to 61-ish, maybe 62 and try and retest it. We think higher prices are now out of the cards completely. We think the market just lives here in this $55 to $60 zone. There is a lot of trading to be had here, so you can make money here. You just got to be aware of the zones, understand what's happening, and more importantly, just don't get stubborn with it. Don't think that it has to go up or it has to go down. As you can tell, this is what oil does. Most commodities do the same thing, but oil is a little bit more dramatic. There's a little bit more eyeballs on it. When it gets into a range, it becomes very range bound. When it breaks the range, it gets very dramatic and it can really get going. So let's just go to a monthly just to get a little bit more some clarity on that. Once it breaks out of these ranges, it really gets going. Obviously, this is negative, so this is COVID. This isn't going to happen on the monthly, but let's just go to a weekly picture. Okay. You could see it chops around, and then it doesn't really look like much, but once it starts to get going, that's when it really gets exciting. Back to the daily, so you could see we've broken through the zones. This was the $62 to $64 zone. This was your zone. We're now out of it. We're out of it to the downside. Originally, we thought that maybe the market would get to 60, hold, bounce off of it, trade between 60, 62-ish in that area, and then break. Friday just was igniter fluid, and it just went. So we're sticking with our call. We believe $55 to $60 is the new home for oil for the time being. Again, tradable, could pop out of it to the upside. It could pop out of it to the downside. But we basically believe that this is where it's going to live the next few days or we basically believe this is where it's going to live for the time being. Let's move on to natural gas. Now, we realized that last week, on Wednesday, Thursday, Friday, natural gas took a little bit of a beating. However, it's still staying within that zone that we were keying in on, which is that $3.10 to $3.50. We got to the upper end of it, $3.50, hung out there for a day or two. Now we're retesting and coming back down to $3.10. We believe the market's going to live here for some time. Again, with these ranges, you can pop out of it, you can pop below it. However, we do believe that it's, for the time being, lives here for the next week or two. We think towards the back end of October, once it starts to really pick up weather-wise in terms of coldness, we think that the market then starts to creep up and then moves on to its next range of $3.50 to $4. We don't believe the market's going to get too much higher than $4. So it's a big range that we're about to put out, and we realize it. However, just given the fact that we have a situation where there's an abundance of inventory, the market may not get as high as we originally anticipated. We originally had a target price of around $4 to $5 in that range. We don't believe that that's realistic at this point or anymore for this year. going into next year. We think the market's going to be in a dollar range, living between $3 and $4. We realize it is a big range, and we understand that. We say we're not saying it lightly. However, given what the backdrop is with regards to inventory and storage, right now, $3.10 to $3.50 is your level one or your zone one. $3.50 to $4 is probably your zone two. If it really starts to get cold. But again, it's tradable. It's moving around, things to do here. So it's woken up. So we definitely think you should keep it on your radar. Again, just like with oil, we do believe that the ranges will be violated. We'll get some movement to the downside. We'll get some movement to the upside. But we think for the most part, for the time being, natural gas will live between this $3.10 and $3.50. And just to recap, we think even on any cold snap, it's probably going as high as $4, and that's about it. We do not believe that it's going to go much higher than that. Now, much higher than that does not mean pokes above and, oh, it went above, it broke $4. It means in the $4 to $5 range. We just don't think the market's going to live there. We just think that for now, for the remaining 6 to 8 months, we think the market's going to be within this $3 to $4 range. It's probably going to live in the $3.50 range. It's probably where it lives. But it is, like we said, it is moving. There's money to be made there. So we think you should be definitely paying attention to it. Let's move on. We're going to start with platinum first. We highlighted certain areas that we thought the market was going to get to. Obviously, the market did not disappoint. We were looking for target one up here at the February 2013 highs of 1744.50. Market got to this past week, got to a high of 1725.70. So just like we were highlighting in silver, we believe this 1750 is going to get taken out this week. We don't see any reason why it shouldn't. We don't believe that the market is going to get to this high of August 2011 as quickly as silver did. We think it might take about a few weeks. With silver, we'll get to it, was a little bit more dramatic. We think with platinum, the market probably lives in the 1750, 1800, kisses that, then backs off, holds, and then makes a run for that 2011 high. For now, we just don't see the explosion in platinum being as dramatic as it was in both gold and silver. Primary reason is because platinum already had that explosion starting in June is when it really woke up, when it broke that 987 area and then just took off. So it's already had a little bit more of a bigger move. So we're of the opinion that the market probably gets to about 1800 or so, and then backs off and then tries to make a run for those 2011 highs back at those August 2011 highs at 1850. We think once it gets there, it's probably a clear shot right to 2000. So platinum is looking really good. Metals took a little bit of a hit on Friday, just like everything else, but it's holding where it needs to hold. And this is what you want to see. You want to see this 1600-ish area hold. It's holding. Right now, your zone that you want to see the market get out of now is 1650, and then it should make a run. There was some news after the market closed that might spark some movement in the metals or gaps. So we're keeping our eye on them. Right now, the most in-play markets right now, by far and away, outside of stocks, are metals. They are what's moving. And that's where you should be, because that's where the money is right now. If you're an intraday trader, the money right now is in metals, plain and simple. And even if you're holding for multi-day, it's a little bit harder with some of these metals being as stretched as they are. The money has been there. We've talked about it ad nauseum. We're not going to regurgitate it because we've already gone over it. But platinum is looking good. Let's move on to silver and then to gold. We're just going to come out and say it. Every single one of our targets that we highlighted over the past few weeks, and when we say every single one, we mean every single one was hit to the upside. Every single target we've been talking about for weeks was hit. Everyone without exception. So for those of you that were following along and held, congratulations. That's awesome. We're very happy for you. For those that were not, hopefully moving forward, these preparation guides will give you some insight on what to look for. Silver was just, wow. This is the month that we've been highlighting this chart for weeks now. There's nothing else to say but wow. What's interesting about silver, we're going to bring up a daily for a quick second. For those of you that know what the red dog reversal or the RDR strategy, silver gave it to you on Thursday. That is that trade. It was pretty much, for those of you that follow and do that strategy, this was pretty much a gift. It was really just a pure gift on Thursday for those of you that took it. So for those of you that did take it short using that strategy, congratulations. Market pulled in. We don't think there's too much more downside. Maybe the market tries to get to 46-ish. We think the market's going to hold now. We think that we're probably going to get a settlement at some point above 50. Now, one thing to note, and we don't have it on this chart, so we're just going to bring it up. We do believe that the market potentially has triple topped. Now, we are not going back that far. However, you can use the 1980s when the Hunt brothers tried to corner the market. That's high number one. In 2011 is high number two. That's your double top. Now, 14 years later, in 2025, you have high number three. This is your triple top. So it's just something that we're highlighting. We wouldn't put too much stock into it. We don't think the market is going to collapse like it did in those previous times as quickly. The world has changed significantly since then. We believe the market probably holds around 46, tries to settle around $50, and then we'll figure it out. Because for right now, we're pretty much at nosebleed territory. We are very overbought across every single metric you could possibly think of. So the market is going to need time to figure out where things are going to go. There are calls for outlandish numbers in oil and gold and silver. We don't buy into that. We're not even going to waste your time by bringing them up. We do believe that to buy it here now, it's a little bit of a chase on any time frame, whether you look at the monthly, the weekly, the daily. You got to wait for things to kind of settle in a little bit. Intraday, you have a little bit more liberty in when you buy it versus when you don't buy it. However, for right now, we believe that you got to be a little bit more careful looking to buy this for a hold. You just got to let the market settle a little bit. But silver looking phenomenally awesome. Let's look at gold quickly. Okay, gold above 4,000, holding, looking good. We're not going to get into the whole gold bug type of situation over there. The reality is it is overbought, just like silver is by every metric. Gold is the most overbought it's been since the 1980s. You really have to be careful buying it here. There's a very big difference between buying physical gold bars and buying gold futures, as well as the GLD ETF. And the same thing applies to silver bars and the SLV ETF. There's a very big difference between buying physical and buying this. So you really have to be careful. You can't, any purchases right now, you're pretty much chasing. So you really have to let the market settle a little bit, find its footing, find its feet, to a large extent, kind of have some choppy action where it's just settling in, consolidating, and then you can look for moves to buy it for longer periods of time to hold. Right now, just like silver, it's very hard. It really is very, very hard. However, the market looks great. We're going to be doing a beginner series on gold, and we're going to release it within the next week or two. We're working on it. We look forward to you watching that. In the interim, again, metals have been the place to be from any metric you could possibly think of. Over the past couple of weeks, the money that has been available to make in trading terms, trading the metal space has been outright phenomenal. Let's look quickly at cocoa. We talked about cocoa last week, waking up. Granted, it's been having some downside moves, but in terms of waking up, it's moving around. It's actually finally somewhat in play and it's tradable. It's not completely insane like it was. When we look at the daily, obviously the trend is down. On the weekly, we're highlighting this 53-ish area. We think the market is going to go here. We don't believe 4,400 is really in the cards right now, unless something exceptionally dramatic happens. We think the market's probably going to settle around this 53, 5,200-ish area and then potentially bounce, but it's been really good for trading. The only problem with cocoa is that it's relatively thin from a volume perspective, but doesn't do that many contracts. A heavy day, is roughly 20,000 to 30,000 contracts. It's been doing 7 to 10,000 contracts. So you really got to be a little bit more careful with it. It's not sweepy or anything like that. It's just liquidity is a little bit of a challenge. But we highlighted it last week as a market in play. We continue to focus in on it in the soft space. We also want to talk about coffee quickly for one quick second. Coffee is holding this $370 level pretty well. We think if the market can get above 390, then we make our move towards that 400, 430 zone. We believe the market can get above 400, then this high is in jeopardy of getting taken out. This is a September 16th, week of September 16th high, or September highs of 424. We think if the market gets back above 400, then this will be taken with ease. And then you're looking out to the February 25 highs of 431. We think we're going to get there, and then possibly 450. If we don't and we break to the downside, then we don't think this 350 is secure. And we think the market probably tries to make a beeline towards this 320 area where we're thinking the market may go. We're going to end off one more time on oil. And the reason why we're doing this is we want to bring up a point. And that point is very simple. A lot of people are watching that $60 thinking that it's a psychological level. It's got a hold. There's trend lines, Fibonacci, swing lows, whatever it is you want to use as a justification for why $60 has to hold outside of maybe it's a whole number as well. The point we're trying to bring out is that when somebody needs to move something, or if somebody wants to move something, trend lines, whole numbers, Fibonacci, moving averages, market profile, footprint, MACD, RSI, oscillators, whatever it is you want to use, it ain't going to work. Crude was a very big example of that on Friday. When crude was holding $60, it bounced back up, at least intraday, it bounced back up. We're just going to go back here for a quick second. This is an hourly. Basically got up to about 60, 50-ish. And then granted there was news, whatever it is. The bottom line was that the next time it came through, it powered through that $60 like it wasn't there. The point we're trying to make is don't be focused on the numbers. Be focused on the price action. Be focused on the direction of where the market is going. Don't try to step in front of things. If you try to step in front of things and catch falling knives, whether it been in oil, whether it been in ES or NQ last week on Friday, or silver and gold, you probably got your clock cleaned. So when you're an intraday trader, focus your attention and your discipline on direction. Stay in the direction of the market. Thanks for watching, and we'll see you on the next one.